All right, let's talk about the markets and a weekend note from our next guest who said he couldn't recall another 9-day period with more potential economic importance. Joining us right now is Barry Knapp. He is managing partner and director of research at Ironsides Macroeconomics. And Barry, let's talk about that. What do you mean that you haven't seen another 9-day period with more potential economic importance? What do we have ahead of us?
Well, you had a good discussion with Steve Leisman a little bit earlier about some of the economic data. I suppose I would toss in the employment cost index on Thursday as well. In addition to, this is belly week, so I joke about that, but this is when the Treasury issues all the securities in the belly, so we struggled to take down 2-year notes and 5-year notes on Monday, and then we received the financing requirements for the next 2 quarters on Monday afternoon at 8:30. We're going to get the Treasury's mix of bills versus coupons and bonds. We all know they've been issuing more bills to try and keep the long end from getting out of control as a consequence of all this supply, but it's very likely they're going to need to increase that issuance next year in the first quarter. So we have a lot of Treasury supply. We have information about how they're going to be supplying those Treasuries. The economic data, which I would really focus on the labor market data. We got that very strong September report, but it's been weak for the better part of the year. And then, of course, getting into next week is the election and, of course, the Fed meeting. And I do think the Fed has the makings of having a discussion about the maturity profile of their portfolio and whether they ought to be facilitating all this government spending. So to me, it's just a wild sequence of 9 days, amidst an interesting election.
The other issue is just what you really think is driving yields higher in the Treasury market. We talked with Steve about that earlier, too. Just this idea, is it a potential for weakness in the economy? Is it concern about the needs for the Treasury with the amount that's coming up? We've seen higher yields, and that it poses a problem just in terms of what it means for budget deficits for the United States, too.
Yeah, there's no doubt that the supply issue is a very big deal. I reject people that say there's been no evidence that the Treasury market hasn't reflected the increase in supply. We saw a very sharp sell-off in the first quarter of 21 after the American Recovery Plan was passed. We saw another sharp sell-off at this time last year. In both cases, Treasury and the Fed took actions to try and tamp that down, but the Fed can't keep monetizing that debt forever. One of the papers presented at Jackson Hole provided plenty of academic evidence that the supply is starting to affect the market. So that's clearly an issue, and I agree with Torsten Slok about that. We had a series of stronger growth numbers. The question is, like the bear market from 1951 to 81, the only thing that interrupted that bear market was recessions or periods of extreme weakness. The only question is the labor market really as strong as that September number implied? If we get a weaker number this one, I think people will look past it a little bit. But I do think the small business sector is weak, and that's really the only thing that can prevent the Treasury market from retesting 5%.
What do you tell investors to do here if you're concerned about some of these issues? If there's so much riding on this, you put more money into the market ahead of this or not?
Not ahead of the Fed, although we've had a pretty healthy position in tech, communication services, industrials, energy. So I would stick with that, but I'd still have a healthy cash holding. You and I have talked about that a couple times this year.
Sure.
I think that still makes sense because there is so much risk. That tax policy issue is a big one.